Hello everyone, my name is Clément Gignac. I'm Senior VP, Chief Economist and Portfolio Manager for IA Financial Group. So over the next 5-6 minutes, I will summarize what we have just done with the webinar to just, in fact, summarize what we see on the big picture and on our strategy, since I'm a portfolio manager and accountable for 5 billion assets under management. So we'll share with you our strategy as well. So let's start with the big picture. It's very good news. In fact, it's a first in 10 years that all the members of OECDs post a positive growth. You know, in the last 10 years, you have already countries in a recession or contraction, but now last quarter was the first in 10 years to have all the players who are post, in fact, a positive economic growth. Very interesting. In Europe, since the Mr. Macron election in France, we see a boost in the business confidence, consumer confidence. As a matter of fact, the euro has shifted from 106 again, the US dollar, to 120. So that reflects the optimism now back in Europe. In US, it's look like the Goldilocks economy will continue. You know, you have a strong economic, you have a positive economic growth with a very low unemployment rate, and wages remain under control, inflation lower than 2%. So that's the reason that after 8 years of economic expansion, that we call that a Goldilocks economy. So of course, make no mistake, if we have now the economy continue and we are more at the 8th inning in the baseball game, if you want, with U.S. economy, in fact, the interest rate have to increase. And the Fed has signaled yesterday the beginning of the end of the QE, or if you prefer, the normalization will continue. So they will remove the non-conventional tool, so they will purchase less bonds. So it's the normalization and interest rate increase as well. So that's the reason that if we have a good economy, on the other hand, you have to be prepared that you will have less liquidity from the Federal Reserve. Shifting to Canada, you know, Canada is very impressive. 2 years ago, if you remember, Alberta was in a recession. Canadian economy flirted with the stagnation due to the soy price, who has dropped at that time from $120, $100 to $30. But now, following the emergency cut put in place by Bank of Canada 2 years ago and the rebound of the oil price, plus the fact that we have a resilient economy and Quebec, Ontario has continued to accelerate. In fact, Canada has shifted from the worst in the class to, and now they lead the G7 according to, we lead the pack, in fact, in the G7 according to IMF. So it's very impressive. So to the situation, what happened? In fact, to explain that, part of the explanation, the Canadian economy and the strength Canadian economy is related to immigration too. As a matter of fact, the population growth in Canada is one of the fastest in OECD, 1.2% a year, and 75% of this population growth come from immigration. So we are fortunate. This immigration profile contribute to the wealth creation and contribute to the real estate boom as well in Canada. So what happened on interest rate? Canadian dollar, you have noticed a 180-degree shift from the Bank of Canada. Earlier this spring, they talk about the fact that you will have no interest rate increase. They have still concern and so on. And suddenly in May and June, they have changed the tune. And in fact, why? Because Canadian economy now perform better than expected, above expectation. The output gap will probably close by year-end. And in such situation, Bank of Canada has already started to increase interest rate. So we do not see the 200 or 300 interest rate increase, of course, but we have to be prepared that we will see further interest rate increase in Canada. As a result, you have now a stronger Loonie. It's no longer 72, 74 cents. It's back to 80 cents. The real value of Canadian dollar is around 83, 85 cents. So since we see probably more interest rate increase in Canada than US due to a stronger economic growth than US, probably the Loonie a year or two from now will be closer to 85 cents than really 78 cents. This is our view. Shifting to conclude on the strategy and the market and the performance of the funds, you know, if we start with the performance of the funds, it's disappointing, and the performance of the Canadian stocks here today compared to US. We have new high, and Wall Street and Canadian stocks have not performed very well. Keep in mind that energy stock has been affected. Canadian bonds not performed very well. So it's disappointing in terms of vintage 2017 so far. But if we look ahead, not in the rear mirror, but if you look ahead, I'm optimistic in that, in fact, Canadian stocks will offer a better return. Now oil price is back to $50. Interest rate increase usually it's better for the financial sector as well. And we see upside in the overseas market. And this is our strategy in the diversified fund that we manage. We, in fact, take profit in U.S. stocks, and now we increase the Canadian exposure and the overseas exposure. So, but make no mistake, you will see probably more volatility in the stock market in the months coming. Why? Because when we have less liquidity from central banks and when we trade at such valuation, very often you see a little bit more volatility. But for anybody who have more 2-3 years time horizon, I'm optimistic because I see no recession and I think the stock market will still provide a better upside than bonds. But it's always important to diversify portfolio. If you want more information, our strategy and our view on the economy and the big picture, we invite you to visit our website at IA. So we wish you good performance and we wish you a very nice fall.